Imagine a single sentence buried deep in a bill that could outlaw a strategy millions quietly rely on. That is the situation developing right now. A major crypto bill designed to bring clarity passed the House with overwhelming support. The industry celebrated a significant win, but that celebration was short-lived. In the Senate, the bill's direction changed. A single provision was inserted, one that could effectively prohibit that strategy. In response, some of the biggest names in crypto are now saying, oppose the bill. So what is really going on with the Clarity Act? What's in the fine print that caused the industry to turn against its own landmark bill? And how could it give Wall Street a permanent, government-enforced advantage? Today, we are breaking down the legislative battle that will define the future of crypto in America. And the outcome hinges on a fundamental conflict that goes far beyond just one bill. So how did a bill intended to provide clarity become a source of such intense conflict? For years, the crypto industry has been operating in a regulatory gray zone. The stalemate was always the same. Who's in charge? The SEC, which often views tokens as securities, or the CFTC, which can treat them as commodities? This confusion has been a massive hurdle, chilling innovation and leaving investors to guess the rules. Then came the Digital Asset Market Clarity Act of 2025, the Clarity Act. On paper, it appeared decisive. Jurisdiction would be split clearly. The CFTC over digital commodities like Bitcoin, the SEC over true securities. And for a moment, it seemed to work. Back in July of 2025, the Clarity Act passed the House with huge bipartisan support. Industry leaders were thrilled. Coinbase championed the bill, urging lawmakers to vote yes to protect consumers. It felt like a new beginning, but the optimism was built on fragile ground. The bill moved to the Senate Banking Committee and then stalled for months with little movement. When a new draft finally emerged, the crypto community raised immediate alarms. A single sentence had been added, and it was aimed directly at one of the most fundamental use cases in the entire market. This is the moment a bill about clarity became a conflict over market structure. The source of this alarm centers on a multi-trillion-dollar conflict of interest. The new Senate draft contains a provision targeting a core use case for many crypto holders. And this is where the issue becomes personal for investors. The new text proposes a ban on anyone, exchanges, custodians, or platforms, from paying you interest or yield just for holding a payment stablecoin. The direct impact is simple: a legally enforced compression of yield competition in US digital dollar markets. So why would they do this? The banking industry saw a direct challenge to their business model. Lobbying groups like the American Bankers Association argued to lawmakers that yield-bearing stablecoins were a threat to their deposit base. Their argument was powerful and simple. If you can earn a competitive yield on a stable digital dollar, why would you keep your money in a bank account earning almost nothing? They even put a number on that fear: a potential $6.6 trillion in deposits could flee community banks and flow into stablecoins. The lobby warned this could cripple the ability of local banks to offer loans for businesses, farms, and families. It was a compelling narrative, and in Washington, it worked. The Blockchain Association, a top crypto advocacy group, fired back. They argued this move sabotaged a carefully built bill and would ultimately punish consumers, especially when banks are notoriously slow to pass on higher interest rates to their customers. But here's the critical difference they pointed out. Stablecoins are typically backed one-to-one by cash and short-term government debt. They aren't lent out over and over like traditional bank deposits. This isn't really about risk, it's about competition. The moment established banks saw a world where you could earn 3.5% on USDC versus less than 1% at your local branch, they leveraged their political influence to counter the proposal. This one sentence has turned a clarity bill into a conflict over the future of consumer finance. This set the stage for a dramatic policy reversal from one of the industry's biggest players. The situation escalated in mid-January 2026. The Senate Banking Committee scheduled a vote to advance the Clarity Act. The momentum was with the banks. Then, in a move that sent a shockwave through the legislative process, a titan of the industry broke ranks. Coinbase, the company that had championed the bill, publicly withdrew its support. The reversal was unexpected. CEO Brian Armstrong declared on social media, "We would rather have no bill than a bad one." He argued that in its current form, the act would leave the US crypto industry in a worse position than it is right now. Think about that for a moment. The existing chaos is considered better than the clarity being offered. It was a direct rejection of the Senate's rewritten framework. Armstrong's top concern was the stablecoin ban, but he also flagged other alarming changes, including what he called a de facto ban on tokenized securities and new DeFi rules that could dramatically expand government surveillance. The fallout was immediate. The Senate Banking Committee was forced to postpone its vote. The White House was reportedly frustrated, seeing the move as derailing months of sensitive negotiations. Treasury Secretary Scott Bessent even went on television to criticize recalcitrant actors for blocking progress. But for many in the crypto world, Coinbase's move was seen as a necessary defensive action. It sent a clear message. The industry would not be pressured into accepting unfavorable rules shaped by the banking lobby. The Clarity Act was no longer a negotiation. It had become a flashpoint. But the visible conflict was hiding the fine print. And that fine print may matter more than the headline fight. While the stablecoin debate captures the headlines, other critical details in the bill warrant closer examination. First, the bill creates a two-tiered system that could favor established institutions. It claims to divide duties between the SEC and CFTC, but contains significant ambiguities. For instance, the CFTC might regulate a crypto market, but the SEC could still intervene if the assets are on an SEC-registered platform. Critics argue this creates a complex framework that larger, well-resourced firms may be better equipped to navigate, effectively allowing them to choose their regulator, a luxury small innovators will not have. This is how complexity becomes an advantage. Second is the potential for diluted investor protection. The bill adds some safeguards like preventing the mixing of customer funds, a direct lesson from FTX, but it also shifts enormous responsibility from the SEC to the CFTC. The SEC's primary mission has always been protecting retail investors. The CFTC, in contrast, has historically focused on commodities markets dominated by giant institutions. The fear is that this shift could weaken the very focus on protecting individual investors. This leads to the third and most urgent danger. The bill gives the CFTC a massive new policing role, without giving it the money to do the job. An underfunded regulator is an ineffective one. Think about what that really means. It means slower investigations, weaker enforcement, and more room for bad actors to operate. It's like asking a single traffic cop to manage an entire city's rush hour. You get the appearance of oversight, not the reality of enforcement. This is where the political endgame begins. The breakdown forced an unusual escalation, direct White House involvement. The Clarity Act is deadlocked over the stablecoin yield ban, and the tension is so high, the White House has stepped in. On Tuesday, February 10th, officials hosted a closed-door summit, bringing banking lobbyists and crypto executives to the same table. Giants like JP Morgan and Bank of America were at the table with firms like Coinbase and Ripple. The meeting was described as constructive, but ended without a resolution. The banks came with a core position, a full legal ban on stablecoin yields. The crypto industry is holding the line. A grassroots campaign, Stand with Crypto, has reportedly flooded Congress with over 250,000 messages demanding they protect stablecoin rewards. We are now at a three-way fork in the road, and the path chosen will define the American crypto market for a generation. Path 1. The banking lobby wins. A version of the Clarity Act passes with the stablecoin yield ban intact. The direct economic consequence would be an outflow of capital from US-based digital asset platforms to more favorable jurisdictions, while domestic innovation in consumer finance is curtailed. Path 2. The crypto industry prevails. The yield ban is removed, and a clearer regulatory framework passes. This would likely trigger significant capital investment into the U.S. crypto market, enhancing regulatory certainty and positioning the U.S. as a leader in digital asset innovation. Path 3. Perpetual gridlock. Perhaps the most likely outcome. Neither side budges and the bill dies in committee. The immediate result is continued regulatory ambiguity, which would likely increase market volatility and accelerate the migration of both talent and capital to jurisdictions with clear legal frameworks. The story of the Clarity Act is no longer about clarity. It's a fundamental power struggle over the future of finance. What began as a good faith effort to write new rules has been reshaped by efforts to protect an existing system. The core conflict, the banking industry's objection to your ability to earn yield, has exposed the stakes. But the hidden dangers are just as real. A regulatory system that may favor insiders, investor protections that could be weaker in practice, and a watchdog that may not have the resources to do its job. It's a choice between competitive markets and protected incumbents. And this brings us back to that single sentence. The true danger was never just about one provision. It's about setting a precedent, one where the legislative process can be used to neutralize competition before it begins. It determines who is allowed to compete and who is regulated out before the race even begins. Now, I want to hear from you. Who do you think this bill is really designed to benefit? Let me know your take in the comments below. And if you found this breakdown valuable, hit that like button and subscribe for more deep dives into the forces shaping our financial world. Thanks for watching.